If you're in the market to buy a new house or refinance an existing home, this may be the most important video you will ever watch about securing a new mortgage loan in the United States. Keep watching if you want to improve your position when making one of the largest financial transactions of your lifetime. The lender and mortgage loan originator you choose during a home purchase or refinance is the most important part of the process. This 3-step how-to video can help you save thousands or tens of thousands on your next mortgage, while also experiencing a much smoother and easier loan process. Step 1. Understanding that mortgage lenders are not really lenders the way you think. Most mortgage loans in the United States are sold to or backed by agencies behind the scenes, and lenders are merely there to verify the checklist of documents required by the borrower. These agencies are responsible for setting the guidelines and providing computerized, automated underwriting approvals. Fannie Mae and Freddie Mac are government-sponsored enterprises that buy all the conventional conforming loans from banks, non-banks, and credit unions in the country. Ginnie Mae is the government agency that backs FHA loans under the Federal Housing Administration and guarantees VA loans for veteran benefits, along with rural housing services under USDA. Understanding that these agencies control all lenders in the country is vitally important so that you're not sold on using a specific lender over another, and instead, embrace lender competition on the same identical loans. Ultimately, you never want any lender or lender's employee to deceive you into thinking they have control when the agencies and investors actually control the lenders. Lender competition is critical for your new mortgage. Step 2. How to choose a mortgage loan originator. Experience and local reputation are vitally important when selecting a mortgage loan originator. While it's great to ask for referrals from a family member, friend, or realtor, certainly don't settle on a referral alone and conduct your own research. Most loan originators today are employees of one lender, meaning they are captive by working for a lender versus the consumer. Other loan originators are true independent mortgage brokers that work for the consumer and embrace lender competition on rates and performance, acting more as a fiduciary. It's important that you have contact with an independent mortgage broker while considering all options. The first place to start is the Nationwide Mortgage Licensing System Consumer Access Portal, or NMLS, which is available to all consumers to review information on a licensed mortgage loan originator. This portal will provide full access to understand how long they have been in the industry by reviewing self-reported employment history or if they have jumped around to too many companies over the years. You can also make sure there have been no enforcement actions on them or the company they work for. The goal here is to make sure that their company is local and to uncover experience and stability. The second place to research is reputation. You will want to do a Google search of the individual and their company for positive or negative reviews to read through. Negative reviews are a red flag, of course, but if you're unable to locate the originator or find positive reviews, that could also be a red flag. Active originators with a positive reputation should be easily accessible online. Remember, this is a business transaction. Even if someone is nice and personable, it is important to dig a little deeper due to the financial and transactional outcomes that will impact your family. Step 3. How to shop mortgage rates and fees. Not shopping for your mortgage can result in thousands or tens of thousands in lost income by unnecessary added expenses. Yet only about half of consumers shop for their mortgage and even spend more time shopping for shoes, according to the Consumer Financial Protection Bureau. Mortgage rates change daily, so you must compare lenders on the same day. It's also important to understand that there is not just one interest rate, but several rates you must compare based on your goals and the anticipated life of your new loan. Some rates will have a lender discount cost, such as points, and other rates will have no points with lender credits. The rate offerings and costs are drastically different from mortgage lenders, so shopping will expose your options and the best personalized rate for you to lock in when the time comes. Here is an example of 2 lender rate sheets we pulled on the same day and time of day for a Fannie Mae conventional conforming 30-year fixed loan. The scenario was a home purchase at $500,000 with 20% down and a 740 FICO score. Remember, this is an identical loan being sold to the same identical agency, Fannie Mae, where the lender is just a pass-through. Interest rates change all the time, But when you compare lenders, you will always find differences when looking at the details. Let's do some quick math by comparing one note interest rate example at 6.125%. Lender 1 rate sheet. 6.125% reflects 0 points and the lender rebate of 0.25% of the loan amount, or $1,000 in lender credit, which can be applied toward third-party closing costs and prepaids. Lender 2 rate sheet. 6.125% reflects discount points and cost of 2.15%, or $8,600 in direct added fees for that rate. Comparing Lender 1 to Lender 2 in this example would cost the home buyer $9,600 more for the same exact loan and rate directly out of pocket at closing. This is an example of what happens daily when consumers don't shop for their mortgage and if they settled on Lender 2 without competition. Here is another example. If you were to compare the same cost between Lender 1 and Lender 2, you would see the difference in their rate offering. We see that Lender 2 at 6.125% was at a cost of $8,600. If we look at Lender 1 rate sheet, we could get an interest rate of 5.5% at a cost of $7,500. This means that with $1,100 lower cost, we could also lower the interest rate by 0.625%, which equates to $159 per month in lower payments. That is over $1,900 per year saved. Over 5 years, nearly $10,000 in payments were saved. And over the life of the loan, a savings of over $57,000. This same pricing and rate sheet comparison should be made on all mortgage loans, including FHA, VA, USDA, or whatever loan type you may be seeking. At Vantage Mortgage Brokers, we serve Oregon and Washington consumers exclusively in the Pacific Northwest. We have created this educational video, however, to inform every consumer in the United States of the steps they need to take to secure the best terms and experience for their families when taking out a new mortgage. If you are buying or refinancing a home in Oregon or Washington, please reach out to one of our team members. As one of the most experienced and top-rated independent mortgage brokers, we would be happy to answer any of your questions and show how our network of competing lender rate sheets helps our clients secure the most favorable terms and experience when seeking a new mortgage on these identical agency and investor-backed loans. We hope you find this 3-step video valuable to secure the best terms and experience when selecting a loan originator and shopping for your mortgage. Please share with others that could also benefit, and happy mortgage hunting!